Hello, everybody. So, welcome to another episode of Taxman's Tidbits. Today, we're going to continue, I believe, part three of our Why Should I Incorporate section. And we're going to talk about rollovers. It's a term you may have heard, it's a term used in the Income Tax Act. And really, what it means is to transfer something that's an eligible property to a corporation, a taxable Canadian corporation, without paying income tax on the transfer. What can be transferred? Things that are generally considered capital in nature, real estate being one of those, and that's what we're going to focus today. Of course, rollovers can be used in a whole host of situations, including transferring self-proprietorships, businesses into corporations, and maybe we'll do that on another day, but that doesn't really touch with real estate. But there's a whole bunch of advantages to transfer your registered non-incorporated business into a corporation, and the main one is that you can sell it and collect about $890,000 of it can be tax-free. But that's for another day. So how does it work? In essence, an individual can transfer real estate that they own into a corporation. Now, the corporation has to be a Canadian corporation. A Quebec Inc. or a Canada Inc. will be fine, but it cannot be a foreign corporation. One of the interesting things that people are not always aware of is that a non-resident who holds property in Canada can also be qualified for this transfer on a tax-free basis. So the non-resident who has property in their own name can transfer it to a Canadian corporation or a Quebec Inc. and not pay tax on the transfer, provided that they, of course, follow all the rules. There are forms to file with the government. There's some legal documents that have to be prepared as well. And all of this is done in order to ensure that, one, the government accepts the transfer as being a valid transfer, and two, that you have all the supporting documents so that down the road the transfer is not considered null and void, or the tax-free portion is not considered null and void, because of course you will affect an actual transfer as you're going to go see a notary, and the notary is going to actually have a deed of sale and transfer and so forth. So the non-resident part is interesting, the resident part is fine. What's really important is you got to remember that an individual transfers, for the most part, it's an individual who transfers to a corporation. In situations where corporations go to corporations, there's other sections that we can discuss, but I think that's out of the scope of today's little video because we're really dealing with individuals who are interested and hopefully making a lot of money with real estate. So why would you even want to transfer a property you own personally into a corporation? Well, there's many reasons, and of course the specifics are case by case. Every individual has a specific fact pattern, and that individual may or may not benefit from a rollover. Some will benefit more, some less. So of course we have the liability issue. Many people want to consider moving things into a corporation in order to protect themselves from third parties and protect their other assets. That's often something that's used because it's much harder for somebody to sue you personally when assets that you hold are held through a corporation. Another thing that we do often is estate planning. So, a parent, has a property, or maybe it's a couple that has a property, and they know that they ultimately want to leave this property to their children. Well, I don't know if you know, but among spouses, when a spouse passes away, the assets normally go to the other spouse on a tax-free basis. So it's a transfer between spouses at cost, and that's the de facto rule. You actually have to make an election for it not to be at cost basis. But when it comes to kids, it's not the same case. When it comes to kids, you have a transfer at fair market value. So if you don't do anything and you own all these real estate assets in your own name, and something happens to you, and if you don't have a spouse and your inheritors are your children, well, the government is going to come in and take their bite of this asset, and the bite's going to be about 25% of the increase in value since you purchased it, plus potential recapture and depreciation and so forth. So strictly from an estate planning perspective, it's something that I suggest to all of my clients to look at least to understand how it works, because the last thing you want to do is leave something to your children and the government takes a quarter of it and you haven't sold anything. Another thing is ease of adding and removing owners. So when you have an individual who owns property, let's just say there's two of us, and we own it 50-50, and for whatever reason we want to bring on a third partner. Well, that means we need to go to a notary and have the third partner put on title, and depending on how it's structured, we may end up being considered having sold a third of the property to this partner, and in that case, we have a capital gain. When we're dealing with a partnership, and I know a few of you have reached out and asked about partnerships, so perhaps I'll do that as a separate video. When it's a partnership, it doesn't necessarily work that way. But you should know that most individuals who own property jointly, it's really structured as a co-ownership and not a partnership. And there are nuances, and I'm not really going to go into it right now, but when you have a co-ownership and we're 50-50 and we add a third partner, we basically sold 1/3 of that property to the partner, or a sixth each of us, and we have a disposition under the Income Tax Act, and we have potential capital gain taxes to pay. One of the things you can do is by having it in a corporation, you can have the corporation issue new shares, and you haven't actually sold anything because the corporation owns the real estate, and now you're just issuing shares in the corporation, and provided you structure it properly, you can avoid being trapped by this capital gains tax. So what are some of the things you need to know about when you want to do these transfers? The first one is fair market value of the property. In fact, real estate is one of the easiest things to obtain a valuation for because you have comparables. So you can either get a comparative market analysis from a certified real estate broker or agent, or you can get an appraiser to give you that comparison. But it's very important to do it and not to simply use the municipal value, because that will be challenged by the government later on if they feel that the value was less than it should be. So why would you want to make it less than it should be? Well, as I said before, some people, what they try to do is they try to deal with estate planning by transferring something to a corporation. So for example, if I own property, and let's just say for argument's sake it's worth $1 million and I paid $500,000, so I've got $500,000 of value in this property, but I want to transfer it to my children in a corporation. So if I was to record the value of the land, of the property, the building and the land, let's just say instead of $1 million, which is what it's really worth, I would record it at $800,000. In essence, what I'm doing is I'm transferring $200,000 of increased value to my children, and I'm not paying tax on that. So Section 85E.1, I believe, of the Income Tax Act deals with these situations when you're doing a transfer to a related person and you don't include the transfer at fair market value. What's going to happen is a double taxation. So you really got to be very careful, and it's important that when you do these transfers that the person who's handling it handles it properly and that they know what they're doing, because mistakes are so easy to make, and unfortunately, once you make a mistake, you can correct it, but it's a little complicated, all right? So everything is fixable within a context, but it's not so obvious. So one of the things you got to consider, though, is that when you want to transfer a property to a corporation, you need to make sure that the bank is willing to do this. And this is one of the first conversations I have with all my clients. I don't get into a complex tax plan and start, charging fees until I have a confirmation that the bank has no issue with transferring it to a corporation, and the bank is okay that new individuals will be involved in that corporation, be they children, spouses, or whomever. Because if the bank doesn't allow this, well, what it means is we need to get a new mortgage, and then we need to take a look and see, well, if you have to get a new mortgage to make it happen, what kind of penalty are we looking at? All of these things need to be considered on the onset, and that's why usually what I do is I do a preliminary consultation with a client to give the client all of the tools that they need and all the questions they need to ask, so that before we get involved in a complex transaction, we know that the transaction is going to work and what it's going to cost them. So in terms of doing a transaction for a rollover, just so you're aware, you've got a fiscalist, someone like myself, who's going to handle the tax side, who's going to really quarterback the entire process to make sure that all the players are doing things properly. You're going to need a lawyer involved because there's documents that need prepared, resolutions for the corporation, a deed of transfer that has to be done as well at the corporate level to make it happen. Thirdly, you've got to involve a notary, because the notary needs to essentially record the title transfer. So you've got three individuals rather, that have to take part in this. And one of the first things I do is I figure out, well, how much is this transaction going to cost, to make sure before we get involved that it makes sense and that you're going to save a substantial amount of money before you spend some money. The banks in general have no issues with issuing a mortgage to a corporation. That being said, it has been my experience that you can't just use any corporation. So if, for example, you've got, a dépanneur, and the dépanneur is incorporated and that's your primary business, and you want to now transfer a rental property into that corporation. most likely the bank is going to say, no, we don't agree to do that because you are now mixing two types of risk. The risk of real estate with the risk of your dependent business, and we're not comfortable with that. Solution, we're going to have you create a new corporation, often considered to be a holding company or investment company, and that corporation will only hold the real estate, and that way the bank can segregate the risk associated to the project apart from your other business. So I'm just letting you know that as well. So usually there's a cost involved to incorporating a business. So as you can see, there are a lot of factors to be handled in a rollover, in a transfer of a property to a corporation. But it's one of the transactions that I do most often, and the reason is the benefits far outweigh the costs, and except in rare circumstances, it doesn't really make sense for people to hold real estate in their own name unless we're talking about maybe a duplex, or we're maybe talking about a condo or something that's not too large and doesn't really have an impact on the financial results of the family. Nonetheless, if you're more curious about this, feel free to reach out to me through Messenger, and it'll be my pleasure to schedule a call to look into it with you. I wish everybody a great day, and if you have any comments, suggestions, leave them below. And for next week, I think maybe I'll talk a little bit about partnerships and co-ownerships, unless I get some juicier topics that people have brought up. So thank you very much. Enjoy the wonderful weather outside. Today is April 9th, and thank goodness summer's on its way, and we're going to say goodbye to the snow and the cold. Goodbye, everybody.